Inventory is tight in the real estate market. Rates are up, and any advantage you can get comes in handy. SchoolsFirst Federal Credit Union wants to help potential home buyers understand the advantages and possible pitfalls of adjustable rate mortgages. It's Financial Wellness Wednesday, and Business Development Manager Lindsey is here to help. Good morning, Lindsey.
Good morning, Desiree. How are you?
I'm doing good, and we're excited to have you on to talk about this. So, Lindsey, can you tell us about the different types of mortgages?
Absolutely. There are two very common types of mortgages in regards to a first mortgage, and that's going to be a fixed rate mortgage and an adjustable rate mortgage, commonly known as an ARM.
And we mentioned that adjustable rate mortgages tend to have a bad reputation. How did that kind of happen?
Well, one of the main factors that contributed to the Great Recession was the foreclosure epidemic, as I like to call it. And what happened there were many predatory lenders gave ARM loans, adjustable rate mortgages, to consumers that truly couldn't afford that home. The property values started to plummet, and consumers and homeowners could not refinance out of that home. And that's where we saw a flood of foreclosures come out. And that's, again, where adjustable rate mortgages at that time really got that bad reputation.
I have to be honest, that's not really making me want to rush out and get one, Lindsey.
Well, I completely understand that point. I do. Now, here's what I can tell you, though, is that the industry and regulators have put some guidelines around adjustable rate mortgages to make sure that they protect the homeowner. And that's really just making sure that you understand exactly the terms of your loans, understanding how and when they can adjust, and making sure that you have plenty of notice before that adjustment takes place. So they're not really as scary as they used to be.
And can you tell us about some of the benefits that come with an adjusted rate mortgage?
Absolutely. The benefit with an adjustable rate mortgage is that it is still amortized over 30 years. That's the most common amortization, basically meaning that that loan payment is spread over the course of 30 years. The difference in interest rates can be significant compared to a fixed rate mortgage, sometimes 1-2% lower than what we're seeing on fixed rate mortgages. Right now, 30-year loans tend to be in or above 5%. And so when you can get into an adjustable rate mortgage at 1-2% lower, it's going to really help you with that monthly payment and how much interest you're going to pay over the life of the loan.
And you've mentioned that the rate adjusts. So what does that look like?
So typically, the rate is going to be set anywhere 3, 5, 7, and even 10 years. It's going to be fixed during those intro periods, if you will. Thereafter, there's going to be limitations when it can adjust, commonly only once a year, and how much it can adjust in that year. Now, again, that said, there are going to be notices sent out to you from your lender well in advance, letting you know of those adjustments.
So what you're saying is that folks should arm themselves with the best mortgage in today's market.
Oh, that was a great dad joke. Yes, absolutely. Absolutely. Really put on your reading glasses. Read the fine print when you're looking at the terms of an adjustable rate mortgage. Make sure that there are those limitations on when it can adjust, how much it can adjust, and speak to a lender that you trust.
And any last tips for our viewers this morning, Lindsey?
If you're looking for more financial advice or looking to get more information on adjustable rate mortgages, please visit our website. We've got a lot of extra credit reports that goes over this information and articles to assist you as well.
Perfect. Lindsey, always a pleasure. Thank you so much for joining us this morning. And we were just taking a look at some of those branch locations. And for more information, visit SchoolsFirstFCU.org.